Well, good morning, everyone. I'm Dina Jensen, the Director of the Center for Nonprofit Leadership at California Lutheran University. A real joy to see you as you're getting settled in. Just a couple of light housekeeping notes. I'm going to be putting into the chat box a number of documents, including Roy's proper introduction, as well as the evaluation form for today's session and this slide deck for today's presentation. We're at about 40 people today, so we'll be welcoming them and inviting them to get settled as Roy gets started. And just want to mention again, we will be recording this session, so be mindful of if you prefer to be off camera. So I will say without a doubt that Roy is one of our most frequent referrals from the nonprofit community and has been a very dear friend for, over 20 years of the Center for Nonprofit Leadership alone, but plays a number of roles at Cal Lutheran in our undergraduate School of Management, as well as in our 50 and Better program. And it is a legal expert as it relates to nonprofit bylaws, ethical considerations, and sticky issues of nonprofit practice. So as you can imagine, as organizations go through our day-to-day lives, it is very frequent that I make a direct call to Roy around issues that exceed my expertise. And he is always very, very generous with not only his time, but his problem solving and expertise. So we're delighted to welcome him. I do encourage you, he's got a depth of experience, and his firm is premier in Ventura County. And this is definitely a scholar and expert that you'll want to have in your contacts. So today we're going to be talking a little bit about fiduciary duties and ethical considerations in the nonprofit boardroom. I know that each of you probably have a set of specific issues that you're hoping to address today. You're welcome throughout today's session to drop those in the chat box. I'll kind of curate them a little bit for Roy, and we'll be asking you to hold your questions until the end of the presentation. We'll be taking a very short 5-minute break at the midpoint, but you're always welcome to take a bio break whenever you need to. And if there's anything that I can do to make you more comfortable during the next couple hours while we have the session, please feel free to reach out to me. So without further ado, Roy, I'm going to hand it over to you. Your slides look great. We're ready to go, and welcome.
Okay. Well, thank you, Dina, and welcome all the dog lovers and cat lovers out there. It's nice to see you. I saw some of you in the chat box, and I know a bunch of you, so it's very nice. And I appreciate you all being here. I appreciate the Center for Nonprofit Leadership. Great organization. If you ever have trouble hearing me, let me know. I got a new microphone for people having trouble. I'll make sure you do it. You should have a copy of the slides available to you. Maybe you can take notes on at some point or whatever. We're going to cover a lot. There may be some specific topics that you'd like more exploration on. Just let Dina know, and we can do a program just on that. We're gonna, your brains will be spinning around when we're done, but please try to pay attention. It's not as good as being in person. Obviously, this is not the best, but it's what we do now, and I think we're gonna make the good time of it. So we'll begin. This is our topic, and it's really broken up into two parts. Part one, and then we'll take a break, and then we'll do part two. This is fiduciary duties of nonprofit board members, and often this alone is a 2-hour program. So we're going to just kind of highlight, and you might have questions. Some of this stuff you know, some of this stuff you won't know. So first of all, these are certain matters that boards are required to vote on, and sometimes they just let other people take care of these things, but these are some of the board responsibilities. So if you're going to open bank accounts or hire, dissolve, fire, set salaries, get D&O insurance, we'll talk about, leasing, purchasing, these really all have to be approved by the board or a board committee like the executive committee, but these are sort of board functions to fulfill your fiduciary duties. Amending the articles, giving membership, setting the membership dues, retirement plans, vacancies, self-dealing. You'll see there's a list here of things that the boards should at least be approving on, and we'll talk more about that. And here's the laws that affect you, right? There's federal law, there's California corporate law, California solicitation laws, prudent investment laws, the tax laws. These are all the laws. And believe it or not, it is never an excuse for you to say, gee, I didn't know that was the law. You are presumed to know all these laws, the thousands of pages of them. There's the presumption you know them all. And maybe you do, but I doubt it. I don't. All right, so here's the potential areas of liability. Believe it or not, as a member of a board of a nonprofit, you have more exposure, more personal liability than people who are on the boards of for-profit companies. And we'll learn why that is, but that's true. So your areas of potential liability is breach of fiduciary duties, which we'll learn about, actions outside the scope of your authority. As a board member, as an officer, you have certain authority. It's either spelled in your bylaws and resolutions, and you can't act outside that. You hire somebody that's not your authority. You buy something that's not part of your authority. Your authority is clearly spelled out either by statute or by documents. Conflict of interest. You're selling things that you own, you're buying things that you have. The board wants to use your services. And we're going to see all these in more detail. Private inurement benefits, that's a big one. You could lose your tax exemption if your nonprofit is really benefiting private interests as opposed to public. Also things like the sexual discrimination, sexual harassment, any kind of discrimination, the board can have personal liability for that, board members, because you're supposed to be paying attention to these things. If you don't take action, you will be named in the lawsuits. Torts and contracts, you got to see how your contracts are. You got to make sure they're signed properly. Got to make sure that there's no personal liability on these contracts. You can avoid it. Personal liability, you have a parking lot. There's always a complaint. There's a big dip in there and it hasn't been fixed. You don't fix it. Someone gets hurt. You can have personal liability. Payroll taxes. None of you know whether payroll taxes are being paid or not. But if somehow they're not, or overtime, or other things aren't being paid, you're going to have liability for that. Oversee formalities. You don't keep the minutes up. You don't file the right forms. And also some nonprofits have very specific rules and laws pertaining to their field. They got to kind of pay attention to these. These are where you can have liability. So what's the standard of conduct? Here's how you have to act. This is the main one. Good faith, honesty of purpose, honesty in fact. You've got to be in good faith, and we'll see what that means. You got to be honest in purpose, honest in fact. There's no ulterior motives. You're doing the best you can. Those can help you a lot in any claims about breach of fiduciary duty. Duty of care, duty of loyalty, duty of obedience, duty to comply with investment standards, prudent investment rules. Okay, so before you serve on a board, and even while you're on a board, from time to time, you need to review the articles of incorporation and bylaws. This is important because for many corporations, they did their articles and bylaws 20 years ago. The description of what you do in your articles has to be the same as they are in your bylaws. Bylaws can be a little more expansive, but they got to match. People change over time. They may be wholly out of date. So from time to time, it's worth looking at the articles and the bylaws, or before you join a board, of course. You always want to be aware of who the current officers and directors are and when their terms expire. Staff positions and salaries, you got to be aware of that. If you can, taking a look at the 1023 form, IRS 1023, that was the form that was filled out to obtain the tax exemption for your entity. Obviously, if it's 10, 15, 20 years old, you're not going to have it. But if you're a fairly recent nonprofit, 5 to 10 years, it's interesting to look at those because they have a lot of questions on there and there's a lot of answers. And you may look at it and say, gee, we're not doing this. So we haven't done that. And it's nice to know what you actually told the IRS. 990s, those are tax returns. 990T, that's if you have unrelated business income tax. And if you have financial statements, audited, unaudited, you got to take a look at those. All right. You also want to look at your mission statement. Also, that's got to tie into your articles and your bylaws. And what's interesting, there's something called mission drift, where you start out doing one thing 15 years ago, and now you're doing things differently, adding new things, changing the focus. You got to look at that because they all got to match. And if you have to make amendments, that can be done. Your website. Do you have a current operational website? It is worse to have an out-of-date website than it is to have no website at all. So you got to have a website up to date, current officers, directors, financials, if you put on there, we recommend that they be transparent. Make available your minutes, and you have all your budgets and your finances, your policies. They can all be on the website, but it's got to be up to date. Got to make sure you have all the policies, and we'll learn about those too. Whistleblowing policies, document retention policies, gift policies, and a list of the board committees. You have to know who the board committees are. And keep in mind that some committees are board committees, some committees are advisory committees. Board committees, usually it is just the executive board. They can make board decisions on certain things. Advisory committees, they can't make decisions, they make recommendations. And you want to look at your directors and officers' liability insurance. Now, it's interesting. I'm sure if I asked any of you, do you have D&O insurance? You would all raise your hand. If I asked you, have you ever seen it? None of you would raise your hand. So that's a very important thing to take a look at, and we'll talk about that too. Okay, so the statute provides that one of your fiduciary duties is the duty of care, and it includes reasonable inquiry that a reasonably prudent person in a like position would exercise under similar circumstances. You'll be judged by the California Attorney General or your members or anybody from the public at what directors would do of a similar sized organization, similar type services. That's how you're judged. You're not going to be judged to the board of directors of the NFL. Okay, that's not your judge. Other nonprofits that are similar to yours, you've got to be like a prudent person. Means you got to reasonable inquiry is a big one. You have to ask questions. If you don't ask questions and things go awry, that's not good. You may have violated your duty of care. So you got to be in good faith, always in good faith. Active participation. You got to be there. You got to show up. You got to read the stuff. You got to talk. And if you don't show up and some decisions made that's not act good, you will be lumped in with the people who made the bad decisions. You breached your duty of care. You didn't catch it. You didn't say, hey, wait a minute, we shouldn't do this. Director primacy. Most of the major decisions of the organization fall under the directors. You can't just delegate it away. You can't say, we'll just hire this manager to manage the operation and leave us alone. It all follows for you. So you got to be very careful that you review, you know what's going on. Prudent person, whatever that is, that's what a jury decides, reasonably prudent person in your circumstances. And actually the main job that you guys have on the board is oversight of financial affairs. The reason that's important is because the money you raise, this is good to remember, the money you raise does not belong to you. It is not your money. It belongs to the people of the state of California. And the Attorney General of California is very concerned about that the money is spent properly. So your principal goal and duties is to watch the money. And it is amazing about how many times I've seen nonprofit boards don't really understand how to read financial statements for nonprofits. It's different than your business. It's different than your personal. I mean, they hand them out. There could be a line item that probably says executive director's embezzlement fund, and most people would approve the budget. And that's bad. So you've got to really, and maybe even take time to have the accountant come in and explain clearly how to read all these nonprofit financials. Okay, so you also have to keep minutes. And contemporaneous, and the IRS has said that contemporaneous is you get your minutes before the next meeting. So it's not like you have to have it the next day or 10 days, but before your next meeting, you should have a set of minutes. You got to bring to the attention any ambiguities, potential problems, things that you see. You actually got to read the minutes, read the stuff that they had and say, wait a minute, this doesn't seem right, or there's an ambiguity. Ask questions. Now, if there are experts that come in and talk to you, you can rely on them, assuming they're reasonably believable. You can rely on them. Your CPA comes in and tells you this is how we're going to keep some kind of accounting. You can rely on that. And even if it turns out wrong, you have done your job. You'll be okay. No loans. You do not make loans to officers or directors. It's a no-no with the Attorney General. Very few exceptions, such as helping out with maybe some housing for your executive director, but that's it. And you should understand a little bit about 501c3, which is what many of you are tax exempt under. So we'll see about that too. Okay, so the business judgment rule, that's something to protect you. Business judgment rule. It doesn't apply to associations. So if you are a nonprofit association, not going to work for corporations. And what it recognizes, and there's statutes, that you're not experts. And even people in business make bad decisions. You can make bad business decisions, but if you acted in good faith, no conflicts. In other words, it's not a question of selling your building to the entity. Then there's no conflicts. And you're in good faith, you believe this is the right thing to do. A reasonably prudent person could make the same decision. And you act in the best interest of the company, you get this business judgment rule, even if the business decision is a bad one and you lose money. This is the protection, which is a good one for corporations. Okay, we also have, I'm going to move this a little bit. Okay, you also, so duty of care, right? You got the idea of duty of care. You also have the duty of loyalty, okay, which is also a statute. No actual or apparent conflicts of interest. California has restrictions on interested directors. No more than 49% of the directors can be compensated in any way, either as independent contractors, as service providers, in any way, 49%. And in determining the 49%, you look at spouses, parents, children, grandchildren, brothers and sisters, and companies that you have at least a 35% interest in. So all those are added up to see if you're an interested director and you can't have more than 49%. It's a lot, yeah, but that is an important rule. That you will lose your tax exemption if you violate those rules. Self-dealing is tough. If you're a private foundation, if any of you are a 501c3 private foundation, there's no self-dealing. I mean, if I have a copier that's worth $12,000, but I paid $5,000 for it, and I sell it to the organization for $5,000, that's self-dealing, penalties, big problems. No self-dealing at all. For public entities, like most of you are, you're allowed to have some. And a self-dealing is a transaction in which a director has a material financial interest. I'm going to be providing accounting services. I'm going to provide the legal services. I'm going to rent the space. I'm going to sell you the copiers. I got a financial interest. And yeah, as you probably know, in those kind of situations, you're supposed to disclose the conflict, the interest that you have. The corporation is supposed to make sure they can't get a better deal elsewhere. They should have gone through those efforts. And that this is the best deal. And the person who has the interest doesn't participate in the discussions or vote. Interestingly about self-dealing, and for the nonprofit public benefit companies that aren't private foundations, you can approve it, but you have to approve the transaction before the event. There's no ratification afterwards. Okay, what this means is there's a 3-year statute of limitations where any member of the public or somebody could sue saying this was not a fair transaction. If they approve beforehand and you follow these steps, that's like 100% defense. If you've already done the self-dealing and realize, either can wait for the 3 years, hope nothing happens, or you can notify the Attorney General, advise the Attorney General, and if they don't care, then that shortens the time to 2 years. So nobody wants to notify the Attorney General of anything. So you probably would never do that. So remember, self-dealing transactions with a board member, or, officers, directors, key employees, perhaps, you want to prove beforehand. No, there's no ratification. Also, for your duty of loyalty, people have to think about other organizations they're involved in. Now, many of us are involved in several. We're philanthropic, we want to help the community, but it is an interest that maybe you want to discuss with the board. For example, in Ventura County, there's maybe 24 people who give all the money. Everybody asks these same people for the money. It's very common. And you're in 2 organizations, you're going to have fundraisers about the same time. Do you have a conflict? Am I going to ask people to go to this one or this other one? It's not illegal. It's not an unlawful conflict, but it's something I think that is fair to talk about and think about. You need that a conflict of interest policy, and has to be signed and updated every year. Okay, so that's clear. Loans we talked about. Corporate opportunity. That's another issue where you could breach your duties. Corporate opportunity. Gee, the company wants to lease office space. So you're on the committee to go find office space. And you're looking around and you say, gee, you know what? This office would be great for my business. So you decide that you're going to pass on the corporation and you're going to lease it for yourself. That's a corporate opportunity, violation of your duties. That could be, your company could set that aside. It's a big deal. And it also might fall under private environment we'll learn about. Confidentiality. What is supposed to be confidential should be confidential. You shouldn't be blabbing them around if it is meant to be confidential. It's something you got to kind of watch. That's part of the loyalty. Okay, duty of obedience is interesting. You got to look at all your governing documents, articles, bylaws, your mission statements, policies, and the federal and state laws, and you got to follow them. You just got to follow them. That's called duty of obedience. The zone of insolvency is a fascinating issue. It's not such a concern today as it was back in 2008 and 2009 during our Great Recession. But generally, the board members are not liable for the debts of the entity. But once you become insolvent, you're actually insolvent. Your liabilities are more than your assets. Then your obligations are no longer to the constituents, no longer the people you help, they're no longer to the public. Your duties are to the creditors. But sometimes you're in the zone of insolvency. And the best example is one I had when I represented a theater, nonprofit theater. They're hanging on by a thread. Gee, we can make this, we owe money, we have enough maybe to pay our creditors, but if we just put on one more play, we'll have enough to keep going. And you're faced with this question, because I'm in the zone of insolvency. Do we put on the play, take a chance that it flops and no money, and now we can't pay the creditors? Now we may have liability because we didn't take care of this. Or do we say, no, we're going to pay our creditors and not do any more plays? So that is an interesting thing. If any of you find yourself in a real financial bind, you want to think about how to go next. Now, as I mentioned, generally the officers and directors and are not trustees. They're not liable personally for debts or the obligations or any liabilities of the company. There are a number of state and federal statutes that protect volunteer directors. Volunteer, if you're paid as a director, more than a nominal sum, then you lose all those statutory protections. The articles and the bylaws should also protect you from liability. However, there are exceptions. And that's why all these statutory protections aren't really that necessary to go into, because they really have very limited benefit. Because the exceptions are breach of duty of care or loyalty. You don't benefit from this, this. Fraud, acts of bad faith. Anybody who decides they're going to sue the board, these are the things they allege. So once they allege you breached the duty of care, you did fraud, you acted in bad faith, you no longer have the statutory protections. Or if you defend some big self-dealing matter and you lose, you're not going to get indemnified. So there's rules about indemnification, but keep in mind, this is why you're going to need the insurance. Even though statutorily you have some protection, they don't mean much in the practical world, because lawyers know how to get around that and make you potentially on the hook. Okay, so and sometimes to indemnify, you have to get court approval. Nonprofits, if you were sued as a board member, sometimes the nonprofits can pay your litigation expenses with a payback agreement. But the best, of course, is the D&O insurance, directors and officers liability insurance. I suggest you get your broker, come to a meeting and tell you what you have. I know so many nonprofits that started 10 years ago, they on a shoestring, they get the least expensive insurance they can get, and they just keep renewing that policy. You want to make sure you've got adequate coverage, $1 million, $2 million, whatever you think it is. It covers past board people, present board people, committees. You want to make sure your committees are covered by the insurance. And there's different kind of policies. You generally don't want what's called a declining limits policy. Declining limits. The declining limits means you have $1 million policy. They will defend you with lawyers, but they will take the cost of the lawyers off of that $1 million. So if the lawsuit is the end of 2-3 years, whatever it is, it's cost $400,000 in lawyers, now you only have $600,000 of coverage. That's called declining limits. If you don't get a declining limit, the whole million stays and the insurance company eats the cost of the lawyers. It's just something to look at. So you really want to have this explained. It's very important what it covers, what it doesn't cover. And there are exclusions, and you really want to look at the nature of your business. You deal with children, you got to have different kind of coverages. So big, this is going to save you at the end of the day. All right. There's also something called private inurement and private benefit. And these are IRS terms, but basically private inurement, it's simple. Nonprofit organizations cannot distribute profits to those who control it. They can't be distributing any money to people or benefits. And actually 501c3 says no part of the net earnings of which inures to the benefit of any private shareholder or individual. Inures, inurement. Private shareholder is considered officers, directors, trustees, managers. They're under the category of shareholders. So it cannot provide undeserved benefits to anybody who is one of those people who control the company, called disqualified people. And we'll see that. Certain rules, and you lose your tax exemption if you do that, but there are some intermediate sanctions that you can be given. Benefit, excess benefits, distributions of assets to members, you can't do that. Insiders, non-fair market purchases. I've got land that you need. The fair market value is $200,000. I sell it to you for $300,000, and I'm a board of director member. I've received a private benefit. Bad stuff happens. Even high annual salary increases, interestingly. Again, this is the people of California's money. It's not your money. So you might have a personnel that you're paying fairly. And common nowadays, maybe it's a 6% raise. You give a 30% raise. And even if that 30% raise, the salary might be okay. Nobody gives 30% raises. That could be excessive. There could be problems, and we'll talk about the problems. Fundraising commissions could also raise problems. That could be excess benefits. Also, too much rent, above market loans. One of your officers, directors, board members, whatever, makes a loan to your company and charges you 12% interest. It's just above market. It's not right. And you can lose your tax exemption. Okay, so private benefit. Say that the inurement thing we talked about is for insiders, people who control the company, officers, directors, managers, even sometimes key donors, people who have influence of the company. They can't make money. They can't make more than it's fair from anything that they do. Private benefit is if you're using your services for private purposes as opposed to public services. It's not just insiders, it's anybody. Your nonprofit has to be designed for a public purpose. That's what you've got to see, to look at. These are all part of the regulations. So some examples of that was one, a nonprofit set up a scholarship program for its staff, scholarship program. But it was only for the staff and the staff's children. Well, that was a private benefit. It's a nonprofit public benefit. They serve food for the homeless. They do all kinds of stuff that they do. They set up a scholarship program for their staff and their staff's children. That was wrong, and they had a lot of problems with the IRS. That's a private benefit. Another interesting one that we also dealt with, art gallery. They wanted to help artists, right? That's a nonprofit public benefit. We're going to help artists, give them some money, provide them training, let them go to schools. We're going to use it for public purposes. And so they set up a gallery. And the deal was the artists could hang their works in the gallery, and the nonprofit charity got 10%, and the artist got 90%. The IRS came in and said, wait a minute, this is not really a public benefit charity. This is a private benefit. All these artists are making money. There's nothing to do with it. It isn't helping the charity. That was a private purpose. You see how that would be? You know, they get 90% of the purchase price of the artist, and the charity gets 10%. You've now set something up to benefit private people. So there were things like that. There was a city beautification program. They set up a nonprofit to beautify the city. and they raised money and they put all these beautiful plants and flowers along this sort of alleyway. Well, in reality, it only benefited a restaurant that was a big contributor and was on the board of directors. And I said that was really a private benefit. So those are things to think about. So if the test is straight for excess benefit is a problem. Is the amount that the charity is whatever the charity getting with what it's giving. Okay? If it's giving more than it's getting, that's an excess benefit. If it receives less than it's supposed to, this is a good definition, excess benefit. Instead of losing your tax exemption, because that's the penalty, there's these other sanctions we'll talk about, and we'll talk about disqualified person and who's a manager and how you can protect yourselves. Okay, so intermediate sanction, if there's an excess benefit, and a good example is, again, you're paying rent too much to one of the board members, you have an executive director who's getting paid too much, those are excess benefits, the IRS can take away your tax exemption. They don't like to do that. So they have this intermediate step for 501c3 and 501c4. So what happens is the person who receives the excess benefit, they have to pay the benefit back to the charity, the excess, and there is a tax penalty of 25% of the excess that the person pays. It's non-deductible. Okay, so if I'm selling you something worth $3,000 for $5,000, then I got to pay the $2,000 back, and I got to pay to the IRS $500 as a penalty. But also, the officers, directors, trustees, they also are going to pay a penalty equal to 10% of the excess. Non-deductible IRS penalty. And you disclose these, by the way, all on the 990 is supposed to be disclosed. So if you don't attend meetings, that's deemed willful and knowledgeable. So if you've overpaid your executive director by $50,000, you'll each pay $5,000 as a non-deductible penalty to the IRS, every board member. So be careful. How do you protect yourself? Well, first of all, who's a disqualified person too about these excess benefits? It's really anyone who in the last 5 years could control the company. Officers, directors, major donors, family members, companies controlled by 35% interest. Those are disqualified people, and key employees, officers, directors, those kind of things. And if they get excess benefits, they get paid too much for what they're giving, there is this penalty, which is bad. So one of the major area where this comes up with is compensation. That's why the 990 tax returns ask if you have a compensation committee, and you should have one. And there's a defense to you if you do that, what's called the safe harbor rule. You can look at comparability. What are other nonprofits paying? You could go to a site called Board Source. There's also the IRS 990s. All the 990s of charities are on there. What are other companies paying? You can do a survey. You can hire somebody and do a compensation survey. Also, if you're executive director or treasurer or any paid staff that's highly paid, they've had offers from other companies to do the same thing, other nonprofits. That's good. Point is, the committee has to do a checking. They got to look at comparable compensation, and you have to document it. You have to bring it to the board. You have minutes approving it, and you attach your survey or your study to the minutes. Okay, that makes sense. All right, so that's important. A compensation committee, and we could help you with that. You might remember a number of years ago, now I think it's probably close to 20 years ago, the Enron scandals. There was the scandals with Enron and Arthur Anderson. Well, the Sarbanes-Oxley Act was passed by Congress, and it applies to the nonprofits as well. SOX, Sarbanes-Oxley. And the 990 asks you these things. I'll repeat this again probably, but the purpose of the 990 is not just to figure out if you owe any money, keep records. The government doesn't have a lot of laws and rules for nonprofits that they have to follow, other than for a public purpose. But the 990 asks all these questions because the IRS believes that if there is good governance, less likely money will go missing. Money will get embezzled. The thing will run better. So they ask a lot of questions, even though the law doesn't necessarily require it. So the 990 will ask if you have a written documentation policy. The law doesn't require that, but you need to have document preservation. So you want to have a policy. So a documentation preservation policy. It is a crime, 20 years in prison if you destroy any documents that are subject to any kind of government review, anything that's part of any kind of investigation. You got to have that. So we recommend that you have a destruction schedule. Some documents you keep forever, some you keep 7 years, some you keep 4 years. It's good to know, and it's good to call out the things where the time is expired. No point keeping potentially dangerous documents longer than the law requires. So that's important. And it's got to cover your accounting, finance, payroll, records, insurance, your legal stuff, your minutes. These are all records. So we recommend a document retention policy. And going back to 990, the IRS asks if you have all these policies, not necessarily because they're required to have a written policy, but if you say no, then you become a red flag and you become an entity they may want to examine. Okay, we'll see that. And you also got to deal with your electronic files and voicemail, how you handle your computer backup. You need to have policies, and you can get IT people to come and help you with that. We also have the whistleblower protection. That's also by Sarbanes-Oxley. They protect whistleblowers, people who contact government entities or agencies or even management about ethical or legal violations they see. You're not supposed to punish them or retaliate against them in any way. So the Form 990 asks if you have a document retention policy. Now, what's interesting, and we'll have a section later, I think, on the 990s. A lot of times people just take the one they had 10 years ago and they just fill it out exactly the same. They just check yes, yes, yes. It is actually important that the board go through all those questions, especially it's in section 6 of the 990. And it says you have these policies and the CPA has just been checking yes all these years. You need to think about it. Because nothing's worse than saying, yes, you have that policy and you don't, and you may not know. And if you don't, you can make one. Okay, so if the company, if you retaliate against somebody who is a whistleblower, you face up to 10 years in federal prison. These are serious matters that the government, Congress decided we want to prevent fraud and waste in companies, including nonprofits. So you want to be obviously proactive in preventing illegal activities. You want to have a reporting system. Some nonprofits have no employees, they got one. It's not the same thing to be concerned about, but you want to have reporting, a way to do anonymous reporting. Some have telephone numbers where people can call anonymously, or you have some kind of a center where you could drop off suggestions and complaints. You should encourage that. And you should investigate every complaint. And if somebody makes a complaint anonymous about actions or activities or something they're questioning, you got to investigate it, even if it seems silly. All that helps you. And California has its own whistleblower protection. It's very similar. So you got federal law and state law. And California has its own document retention policy as well. Okay, well, we actually finished sooner than I thought for the first half, which is fine. I think the second half is going to be longer because we get into ethics policies. Does anybody have any questions?
So
Dina?
Roy, I have a question from the chat box. It's a question, is the liability the same for a nonprofit that is 100% volunteer run versus a nonprofit that has paid employees? And what should a nonprofit that is volunteer run watch for?
Those are good questions, very good questions. And I think we address that in the next part too. But yes, there's different kind of liabilities. If you have employee run, you've got all the liabilities that deal with employees, harassment, wage and hour violations, and all those things, meal breaks and rest breaks, everything done properly. The issue that comes up with all volunteer is, are these people really volunteers? And in the last few years, the law has developed so that maybe you're not really a volunteer. People call people volunteers, but they're really employees. Are they doing something employees normally do? Are they doing something that you would normally hire somebody to do? Are you controlling when they come, where they go, what they do? It is possible that a volunteer could be an employee, which means now you have liability if they get injured, workers' compensation if you didn't have, plus wage and hour laws. And there are some statutes and there's issues that deal with what is a true volunteer. So you have to think about it. Now, obviously, usually startup nonprofits, everybody just kind of works. But if somebody or a couple of people are doing day-to-day 9-to-5 stuff, they may be employees. I mean, we had a situation with a symphony, nonprofit, orchestra, and they had conductors volunteering. They're really not volunteers. Had to pay them, and you can't pay people stipends. You can't say I'll give you a $200 stipend. Either they're employees or they're not. And by paying a stipend, you're basically saying, I think you're an employee, and opens a can of worms. You're better off paying nothing than a stipend. So those are issues that need to be examined. That's a very good question. Not an easy answer.
That's the only question at this moment, before we take a quick break. If there are any other questions, you're welcome to come off mic or place them in the chat box.
Okay, you're all good? You're all confused?
Roy, I got one more. Are there rules about how much an organization must spend on achieving its public purpose versus how much it sets aside for reserves?
Okay, basically, you're supposed to substantially spend your money for your public purposes. There's no prohibition about reserves. However, if you make $1 million and you keep 950,000 in reserve, that's questionable. As long as you have a justification for the reserve and you're substantially spending the money that you do spend on public purposes, you're fine. It's not a black letter rule at all. That makes sense? Okay. Anybody else have a question on this subject? You never know how many questions or how long things are going to take. Okay, why don't we take, 5 minutes or so, we'll come back and then we'll have more time to do the second part and ask questions. And if we finish early, we finish early. So should we do that? Take our break now?
That sounds fantastic. How about if we come back shortly before 5 to 10?
That sounds good.
Great.
Okay, thank you.
Thank you. So Roy, as we're coming back, there was an additional question about reserves that maybe when you get started again. It's a question about having received a large estate gift and putting it into an investment account and whether or not that's considered a reserve.
Well, that could be considered an endowment
Mhm.
or a quasi endowment. They can treat it however they would like. They could talk to their accountant, but if it is reserved for a rainy day, maybe they can treat it as endowment or quasi endowment, which means that they have more control over it, or they can just keep it as reserve if they plan on spending it. If they only plan on taking the income from it or 5% of it every year, then they might as well try to actually formally set up some kind of an endowment.
Sure.
And it's income. It's it may, if it's large enough, it may put them into the area where they got to do the audit,
Sure.
the Nonprofit Integrity Act. Yeah.
Thanks for that.
Okay, I think the next one might take longer, so we should see.
Sure. Well, why don't we go ahead and get started? It's a little hard to gauge whether folks are all back, but I think once we get started, folks will put their cameras back on. Great.
They'll wander in.
Yes. So we're ready when you are, Roy.
Okay, well, welcome back, everybody. Thank you for coming back and joining us. I appreciate that. This is a little bit different than the first one on fiduciary duties. Fiduciary duties, there's statutes, there's lots of cases. There's rules that are fairly clear, and so it's much easier to follow. Ethics, totally different. We're not talking about statutes. We're not even talking about cases, because ethics and law are not necessarily the same thing. And so it's a little more squishy, maybe a little more cerebral, maybe a little more harder to follow along. But it is interesting and it's fascinating and it's something to think about. And in this ethics presentation, we'll draw upon ethics in real life, in the business world, and in the nonprofit world, because the subject of ethics comes up all the time. And we need to have some understanding of what it is. And you will learn when we're done. It's such a difficult subject, and people can have different views. And I am called sometimes to come to nonprofits or to businesses to help them make ethical decisions, because a wrong ethical decision can have legal implications. But this is more of a philosophy, and some of it is opinion, and you all obviously have your own. So we'll see how this works. Ethical considerations. It's a fascinating subject. It's sometimes I'll teach a whole semester. We're going to get this in an hour or less. So bear with me. First, keep in mind that a nonprofit is business. Nonprofits are big business. So a lot of the rules are the same. There's $380 billion were donated in 2020. Millions of people work for them. There's millions of nonprofits. That's almost 3% of our gross domestic product is donations to expenditures by nonprofits. They have trillions in assets. And California alone has over 80,000 nonprofits that are registered. This is big business, right? It's not just mom and pop stuff. So let's define the dilemma. The dilemma, of course, is what are ethical issues that come up and why do people, we will learn, make obviously unethical decisions? And that's always an interesting discussion. Okay, one interesting case that came up, you may remember it, the kidney sale. Something you may wonder, does this have ethical implications at all? This was a famous matter. Somebody decided, you know what, I got 2 kidneys. I don't need them both. I think I'll auction one off on eBay. And it actually went up to $5.7 million. What do you think? Is that, before I tell you whether you can legal or not, is that an ethical thing to do, to auction off your body parts? It's my kidney, Why shouldn't I do what I want? Okay, some of you may think it's your kidney, do what you want. Well, one, it's not legal. You may not sell your body parts, but also it raises ethical issues clearly. And there was a lot of discussion by ethicists about it, because if you're allowed to sell your kidney, guess who gets the kidney and guess who doesn't get the kidney? You know, the 70-year-old millionaire gets the kidney and the 10-year-old dying kid doesn't. And that's an ethical issue. The Ford Pinto, that can be used in a lot of different cases. And it talks about how this could happen. And nonprofits are in the same category. In the 1960s and early 70s, the American automobile industry was in big trouble. We kept making big gas guzzling cars, and the Japanese were making small gas efficient cars and beating our butts. So Lee Iacocca, chairman of Ford, said, we got to make a car that's going to compete with those that we could build and sell for $2,000. And some of you will know the name. I don't know if any of you actually ever saw the car, but they built this car and they cut the time down from drawing board to production from 4.5 years to 2.5 years. They rushed them out. They determined that they would be selling about 11 million cars, 1.5 million trucks. As that's rolling off the assembly line, the technicians, the engineers come to the executives and say, wait a minute, there's a flaw in this car. If you rear end it going at 20 miles an hour, it will explode and people in there will die. So the board of directors of Ford, what are we going to do? So it would cost $11 a car to fix, $11. That would be $137 million. So they did an analysis. What would it cost to pay for people who got burned and killed, just burned and injured, and to replace the cars? $49.5 million. So they decided, you know what, let's put $49.5 million in the bank and we'll keep these cars going. Okay, they did. Somebody bought this car for their daughter. She was driving with her cousin. They're pulling off the freeway. Some car clips them in the rear end, going about 15, 20 miles an hour. Gas tank explodes. They die. So they sue. Again, they sue Ford. This internal memos about the board deciding we'll put away $49 million in the bank. We won't spend $137 million. It's too much money. Got out, and the jury wouldn't be happy, like you wouldn't. And they hit Ford with, at that time, the largest punitive damages ever in history, $100 million to punish them. So a question, of course, and we'll see if we go through, is, gee, assuming these Ford executives are regular folks like you and me, you know, they help their kids, coach their kids' soccer team, they go to church, a temple, they're on charitable boards, they're just regular good folk. Why would they make a decision like that? What is it? And we'll learn it's not greed and it's not just money. There's other things, but those are the things that boards have to consider. Falsifying fundraising expenses, that's a big one. Many nonprofits like to put down zero or very little for fundraising expenses, and they're just not true. It's never zero. It just isn't. There's cost of something, but they don't like people to think they spend a lot of money raising the money. And that is an ethical issue. The California Attorney General just recently sued 2 charities to support nonprofit veterans. And these charities basically were paying their people way too much, high lifestyles, and very little was actually going to the veterans. Why would boards sit there and even allow that? What would be the reason for a board member like you and me sit there and think that's fine? The case of McDonald's coffee, you're familiar with that. This was a grandmother, and her grandson got his driver's license and said, Grandma, where do you like to go? She goes, I'd like coffee. So he said, all right, I'll take you to McDonald's drive-through. So he goes through the drive-through, and she's not used to going through drive-through. She just didn't do it. She got the coffee. She's wearing shorts, put it between her legs, opened the top, pour in the cream. The grandson started to take off, and it spilled on her. The coffee was 190 degrees. Anything over 140 is inconsumable. And she almost died. She was in the hospital for 2 weeks with 3rd-degree burns. Coffee, hot liquids between 180 degrees will cause 3rd-degree burns in 2 to 7 seconds. Almost died. So she asked for $20,000, her lawyer, just her out-of-pocket expense, And McDonald's said, no, you don't even get a Big Mac from us, pound sand. So they sued. And it turned out that McDonald's defense was, oh, people like to buy the coffee hot and they go to work, and they can drink it. Well, at 180 and 90 degrees, it takes 20 minutes to get down below 140 where you could drink it. The fact is they get more coffee from the beans. It was all like that. And one of the executives on the stand was asked, why you do this? He goes, well, we sell millions of cups of coffee a day. And they presented to this guy that there's about 2,000 or 3,000 burn victims a year. He goes, that's insignificant. That is a statistically insignificant number. We don't need to be concerned. So if you were the jury, you would not be happy. And they gave this lady $2.7 million, which was 2 days coffee sales. Why would they do that? Assuming, again, these are regular folks. Well, okay, I get burned. This is a money thing. We all know about Wells Fargo and pressure. They've had to pay billions of dollars in fines and judgments because, and nonprofits could fall into the same thing, where they put a lot of pressure. If you got hired by Wells Fargo a few years ago, you were told, if you were a teller, you have to open up so many accounts, you've got to get so many loans, you got to get so many credit cards, or you're fired. You have 6 months to do it. So people were so stressed and trying to meet their goals that some of these poor tellers would open up accounts for people and put their own money in. And some customers say, no, I don't want a credit card. They got a credit card. No, I don't need a loan. I don't need insurance for my mortgage. They would get insurance for their mortgage because of the pressure. And that can happen in a nonprofit world too. If you have some goals that you want to pressure people, especially in the fundraising areas, which we'll get to, it could be too much. And people do ethical lapses. Believe it or not, on the 990, there's actually a question about diversion of assets, which is a fancy way of saying theft and embezzlement. And thousands of nonprofits actually do report, yes, even excessive benefits, compensation could be considered a theft. So we'll talk about that. And they do. So why would that be? And it seems nonprofits are more ripe for embezzlement and wrongdoing with money than for-profit businesses, and maybe because nobody pays attention, as I mentioned, they're not really looking at the financials. So we'll see that. All right, so here's a nonprofit recently had to pay $4.3 million to the False Claims Act and $1.4 million for charging unnecessary non-existent services. Now, why would nonprofits do that? Say, we're going to serve 400 people, we only serve 300 people, and I don't even provide the services at all. I got to fix something here. They don't provide the services at all for the people. Excessive compensation. This can really hurt a nonprofit. New York Public Library CEO was paid $800,000. Now, that may be reasonable. I have no idea. But their donations dropped dramatically after that. That just seems like a lot of money for a nonprofit. So those are things to obviously think about. What is ethics? Okay, ethics is not the same as feelings. It's not religion. It's not just following the law. It's not just following acceptable norms, and it's not science. So let's see how ethics actually works. All right, what is ethics? What's the definition? Well, it's interesting. There's ethics and there's morality. We do use the terms interchangeably, but they're not the same, technically. Morality is really the philosophy that you have in making right and wrong decisions. It's the nature and grounds of your moral spaces. What do I think is right? What do I think is wrong? And what is my basis for believing those things? Ethics is really more the study of how you apply those principles in real life situations. We use the terms interchangeably, and really to ask yourself about ethics, it's really right and wrong. It's the study of right and wrong in life, right and wrong in business, right and wrong in the nonprofit world. But it is a little bit different than morality, but we use them interchangeably. Is it black or white? This is always an interesting discussion. Is ethics black and white? Is something always wrong and right, or it can something be right and be wrong and then be stuff in the middle? That's an interesting discussion about that. For many people, ethics right is black and white. If it's wrong, it's wrong. If it's right, it's right. There is no in between. For most of us, there is this in between. But keep in mind, in between doesn't make it right or wrong. There's a difference, and here's some examples. On my first job as a lawyer, I had a legal secretary, and I was a lawyer for Bank of America in their legal department. And my legal secretary sat in a desk in front of my office, and the phone would ring, and she would say, "Oh, Mr. Smith, Mr. Schneider." And I would be in my office waving, "Tell him I'm not here." And she would say, "He's right here." I went to her and said, "Well, why would you do that?" And she said, "Well, I can't lie. Lying is wrong." For her, this was the world, right and wrong, couldn't do it. So after that, if somebody called and she answered the phone, "Mr. Smith, Mr. Schneider," I would have to duck behind my desk, and she would say, "I don't see him right now." How long did she last in that job? Nanoseconds. So her job description was to lie. And if any of you have ever been an administrative assistant, that's part of your job. "Oh, Mr. Smith can't see you right now. He's busy." Well, he's not. Or he has another appointment. So how does that affect ethics when that's part of the job? One of the first times that I had an epiphany about ethics and right and wrong was kind of interesting. I thought about it. When my daughter was 6, I took her to San Francisco to ride the trolley and go on the trolley. And I told her that if the conductor asks her how old she is, say she's 5. And she goes, "Well, I'm 6. I said, "Well, I know, but 5 is free. Say you're 5. So we're going on the trolley. The conductor comes up to her and says, "Oh, what a pretty little girl you are." And she said, "Thanks." And he goes, "How old are you?" And she goes, "I'm 5. And he said, "Oh, great. When are you going to be 6? And she said, "As soon as I get off this trolley." So that was not a good moment. And I thought, "Oh my God, I'm not going to have a serial killer for a daughter." But I realized everybody kind of laughed, and the conductor laughed, and we had that kind of knowing look from one parent to another. It wasn't the end of the world. Or have any of you ever ordered your 11-year-old child from the 10 and under menu? Or your parents do that for you? My guess is yes. Have you ever heard of the term a white lie? It's just a white lie. There's no such thing. It's a made-up term. It's either true or it's not true. People say white lie because it sounds better, but it's either true or it's not true. So people who live like this, life is pretty simple. Most of us can't live that way. People who like this, we can all agree that certain things are right. We can all agree that certain things are wrong. The middle stuff really is not gray, It's either right or it's wrong. It's who cares? You know what I mean? It doesn't make a difference. And so when thinking about ethics in our professional lives, in our personal lives, in our board lives, there are certain things that just don't matter, and we can't get hung up on those. And that's my philosophy. I have a friend that is right and wrong. I mean, we would go to Dodger Stadium, and there's a seat, 10 rows up, and it's the 3rd inning. I say, "Let's go move down." And he refused because that'd be stealing that seat. People can live like that. That's great. So keep in mind that there are things that are not really that important. And if you think about it, you're going to drive yourself crazy. All right. So why do people make obviously unethical decisions like the Ford, the McDonald's, the veterans groups? And why would they do it? Is it just greed? No, that's too simple of an answer, because not a lot of these people who made these decisions at Ford made any money from it. McDonald's, the people who said, "Let's just, burn the people," they don't make any more money from it. But it's not just greed. One of the problems, and in nonprofits too, especially bigger ones, there's no accountability. We never know who the wrongdoer was. Lee Iacocca was long gone from Ford by the time the lawsuits happened with the Pinto. I didn't tell you, Pinto. You've heard of the Pinto? Some of you may have actually seen a Pinto. I hope none of you ever owned a Pinto. It was the worst car ever made, maybe next to the Etzel. It was a bad car. The conformity concept, they did all these studies, which are fascinating in ethics. So they had pictures like this on the board, A, B, C, and D. And they would call 25 people in a room, 24 are in on the deal, 1 has no idea. And they would go around the room, which 2 sizes are the same? and they would say A and B, A and B, A and B, A and B. They'd go to the test subject. 9 out of 10 times, the test subject said A and B. And I said, well, why would you say that? It's obviously not A and B, maybe A and C, but it's clearly not A and B. Why would you say it? Because everybody else thought that's what it was. How could I, maybe I'm wrong. Maybe I'm not seeing it right. I mean, conformity is huge. Just think back when you were in middle school, your life was to look like everybody else. You wanted to fit in. So conformity, that's a study. So if you're in any kind of organization and everybody is seeing something a certain way, you're going to see it that way as well. And that may not be appropriate. Groupthink. How can I go against the group? You've got a cohesive group. We want to do this activity. I think we should try this purpose. We should add this program. And everybody's high-fiving themselves. What a great idea. You will begin to think that as well. Groupthink is an easy thing. I mean, you can just look at our current political climate. The whole idea of groupthink. How many people think certain things because something's told to them? I mean, it's groupthink. It's just a weird thing in your brain that you'll begin to think like the people you're with in a cohesive group. The bystander apathy was also fascinating, and it applies to business and nonprofits as well. In March of 1964, this young woman, Kitty Genovese, was getting off work at 1 a.m. From 2 a.m. from her bar. She was a manager of a bar in New York, and she was going to drive home. A man named Winston Mosley decided to follow her. He followed her. She parked her car about 100 feet from her apartment, started walking to her apartment. He got out of his car and stabbed her in the back. She started to scream, right? Scream loudly. 40 windows up in her apartment building, the lights went on because the screams were so loud. Somebody even yelled out the window, hey, what's going on? So Winston Mosley ran away. 10 minutes later, no sirens, all the lights are off, nothing's happening. He goes back. Meanwhile, she had crawled around the side of the building because she couldn't go up the stairs anymore. He found her, screaming again. He stabbed her, he raped her, strangled her, stole $49 from her purse, and stabbed her to death. This took 40 minutes. Nobody called the police. Nobody came out. Nobody did anything. And we've seen this repeat itself over and over again. Just this last year at a high school dance outside the gym, a young girl was gang raped for over an hour. And people would go outside, they'd look, some would participate, they would take a break. Nobody told the teachers, nobody did anything to help her. A couple of years ago, right on the 101 up the coast, a young lady, her car broke down. She parked on the side of the road. Somebody stopped his car. He came out and he sexually assaulted her and raped her while over 2,000 cars drove by. Nobody called the police. Nobody stopped until she was laying there by herself, bleeding on the side of the road. And the sociologists say the more people that watch something bad happening, the less likely any one person will do anything about it. It's a fact. So even in any organization, even nonprofit, if there's something that's not right, but there's 10, 15, 20, 30 people who see it and know what's going on, no one is going to do anything about it. But if you understand his concept, maybe you'll say, wait a minute, I'm going to not be this bystander. It's a fascinating subject. The electric shock study also is one of those fascinating ones where they've done over and over and over again. And it's important to know, even certainly in the nonprofit world too, where you have hierarchies. This was a guy named Stanley Milgram. He was a professor at Yale. And he was fascinated in 1961 about the trial of Adolf Eichmann. And Adolf Eichmann's defense was, I was following orders. This is what I was told to do. That was the law. I was following orders. So Stanley couldn't understand how somebody could do these horrible things because someone else tells them to do it. So he set up this experiment at Yale. He put an ad in the paper. They was going to pay $6 for an hour of your time. Now, in 1961, the minimum wage was $1.15. So $6 sounded pretty good. So he got students and he got neighbors from the community. Hundreds of people volunteered. And it was all set up. There was a whole bunch of people who was in on this deal. So one of the people who came in to get their $6, he would say, okay, you and Sam pull a number out of a hat. They always knew what number the victim was going to get. They say, okay, you're going to be the guy that sits in front of this one-way glass. You can see in, and the other person can't see out, which wasn't true, but that's what they told them. And inside the room, on the other side of the glass, was a chair with all these electrodes. They said, and here's a dial, and you're going to turn the dial when I tell you to turn the dial. So they hooked the person up with electrodes, and the dial itself went from 15 volts to 450 volts, and had little warning signs, warning, danger, excessive, skull and crossbones. And Stanley would be in a white coat, and he would tell the person, okay, turn the dial. And you turn a little bit. Okay, turn it some more. Turn a little more. All of a sudden, the person in the chair starts squirming. Now, it's all fake, but you wouldn't know that. Squirming. Turn it some more. Then more screaming. Then more. And then begging and crying and carrying on. And all the way up to 450 volts. And the person was like hysterical. When it was done, they asked people, why'd you do that? Why would you turn this all the way up and make this person suffer so? Well, the guy, the guy's wearing a white coat. Says, doctor, he told me to do it. I was part of the experiment. This is Yale University. He didn't actually hurt anybody. And he wrote that before he did this, that 3% of the people would actually turn it to 450 degrees. It was 65% of the students turned it all the way to 450 degrees. The volts. So the lesson is, you have people working for you, you're working for somebody, even in a nonprofit, and somebody who you respect, here that guy in a white coat, you respect, you think they know what they're doing, and they say, I think we should do this, you'll do it. 65% of you will go along with it, even if it's a horrible thing to do. They've done this experiment hundreds of times since then. It's a fascinating study of human beings, which is amazing. Now, law and morality, they're not the same. But there are some things that are the same. Some laws have no moral or ethical basis, right? Some laws have none. Driving on the right side of the road, there's no ethical or moral issue involved. Some laws are immoral, and people can disagree. We may think Jim Crow laws are immoral. Some may think abortion stuff is immoral, same-sex marriage, death penalty, all those things. Some laws are immoral. I think we'll all agree that Jim Crow laws are immoral. But how do you deal with that? But some laws are immoral. Can society legislate morality? Can society make laws that makes you ethical and moral? People have always argued that, you can't legislate morality. Well, we do to some extent, because we have laws that say, for example, if you make promises in a certain way, you have to fulfill them. You could be sued. If you injure somebody, you may have to pay them for your injury. But as a general rule, it's pretty hard to, we have laws that say you can't be a bigot, maybe. You may want to be a bigot, but you can't be. So we have laws that sometimes you may think that's a moral issue. Fascinatingly, there has been one major law that had no purpose other than morality and ethics. Had no purpose. And actually was a constitutional amendment. Let me know what that was. I could read your mouths, we mouthed it out. But it was prohibition. It had no purpose. There's no economics involved. It's just that they thought, hey, people are not good when they're drunk. So we're going to prohibit alcohol. Interestingly, the people who pushed that law were women. And women couldn't even vote. But people who study these things, they pushed it because their husbands came home drink, and beat them up. So they figured, gee, if they don't drink, I won't get beaten. Was that a successful law? Prohibition? No. Think about this. Constitutional amendment requires 2/3 of the House, 2/3 of the Senate, and 3/4 of the states. And we could not possibly conceive of 2/3 of the House, 2/3 of the Senate agreeing on anything, plus 3/4 of the states. So they passed that prohibition. Then a few years later, they had to do another constitutional amendment to get rid of it. It had no purpose but morality, and it failed. Does society, Does society's ethical values change over time? Now, how does that fit with ethics? How could something be ethical today and tomorrow be immoral? Well, the reality is society's views of ethics and right and wrong do change in the for-profit world, in our lives, and in the nonprofit world. It changes. And part of it is because we learn as we grow. We only know what we know. Believe it or not, in the 19th century, late 19th century, through the 20th century, and the society's views of women, ethical, moral views of women, let's stick with them, have changed, or things like that. And in the late 19th century, even through the early 20th century, in many states, women were not allowed to become lawyers. They just weren't, as men. There was a young lady that went to the University of Illinois, got a law degree, passed the bar, but she could not be a lawyer. So she sued. And it went to the United States Supreme Court. And this was the view. Okay, this was the ethical, moral view of women in the late 19th century. It says, the civil law, as well as nature herself, has always recognized a wide difference in the respective spheres and destinies of man and woman. Man is or should be women's protector and defender. The natural and proper timidity and delicacy which belongs to the female sex evidently unfits it for many of the occupations of civil life. The constitution of the family, which is founded in the divine ordinance, as well as in the nature of things, indicates the domestic sphere, as which it properly belongs to the domain and functions of womanhood. And the Supreme Court concludes by saying the paramount destiny and mission of women are to fulfill the noble and benign offices of wife and mother. This is the law of the Creator, the laws of our Constitution, and the rules of civil society. Now, was that an accurate description? Okay, now, we can say that, well, he only knew, this judge who wrote this, Supreme Court justice, only knew what he knew. He grew up, saw his mother, father, but that became the law. That was the rule, women ruled that they had. But it was wrong. And it changed, right? We have a different view of women. Believe it or not, until 1967, it was a crime in most states called the crime of miscegenation, which is interracial marriage. It was a crime. You went to jail for that. The famous case of that was Loving versus Virginia, where a black and white couple, she was black, he was white. They got married in Washington, D.C., where you're allowed to be intermarried. They moved to his home in Virginia. SWAT team came in the middle of the night, arrested them for this crime of miscegenation. And the court found him guilty and said, you have a choice. You can either go to prison or you can agree to leave Virginia and never come back again. So they left. They contacted Bobby Kennedy, who was the Attorney General at that time. He got a hold of ACLU, and it went all the way to the U.S. Supreme Court. Now they allow interracial marriages. That may be on a chopping block again, who knows? But it was viewed as immoral for blacks and whites, so any to mix. And in fact, the trial court that found them guilty said that this actually is what God wants. They used to bring God into their cases, because if God wanted the races to mix, he wouldn't have put them on different continents. Okay, now that was the reason. It's kind of nuts. Believe it or not, until 2003, same-sex intimate contact was a crime in a number of states. So it was a crime to be gay. In Texas, there was these gay people. They were there. The landlord couldn't stand it, called the police, said there's a drug thing going on here, which there wasn't. Cops bust in, the two men were in bed. They were arrested for the crime of sodomy in Texas and sentenced to prison. It was a crime. We're talking 2003. It went to the Supreme Court, and they said, no, they struck that down. Okay, they said it's just unconstitutional. It's not the right views. And interestingly, how things have changed not that long ago. Believe it or not, in 1966, not that long ago, well, this is even before that. 1966 was fascinating. Have you ever heard of Bobby Gibb? Bobby Gibb? She was the first woman to run the Boston Marathon. And she did it illegally. She trained for a couple of years. You have to apply to go to the Boston Marathon. So she sent her application in, and it was turned down because the committee, the Boston Marathon Committee, said women can't run 26 miles. They can only run 2. If they run 26 miles, they'll die. So no women were allowed to run in the Boston Marathon. So she put on a hoodie and shorts, hid in the bushes. And when the people started to run by, she ran out with the crowd and finished it. And it was, oh my God, the yelling, the screaming, the cursing, the punishment. And 50 years later, she became the Grand Marshal of the Boston Marathon. But 1966, when this happened, there were no women baggers in supermarkets. There were no women workers at McDonald's. There were no women presidents of universities, no women FBI agents. Women were actually told why they got paid less than men. And a married woman had to get her husband's consent for a mastectomy. So the society's views of right and wrong have changed. Obviously, I mean, there was a time when people thought slavery was the moral thing. It was a moral, godly thing to do to have slaves. Okay, so it changes. So that obviously complicates a lot, doesn't it? Okay. So I throw that in there, but so it does change over time. All right, does just compliance with the law satisfy all your ethical considerations? Interesting. So there's examples like that. The Toy Story. So here you are, you have a toy manufacturing company, and you put all your resources into this toy, and you're supporting 30 employees, you're supporting your elderly parents, you're paying for your kid to go to college, but you really count on this toy. Before the toy can be sold, the Consumer Product Safety Commission comes along and says, you can't sell that toy. It's not safe, it'll hurt kids. So it's a choice. You can sell the toy in Mexico because it's legal. Do you scrap the whole thing and your parents start eating dog food and your kids dropping out of college and all your workers are unemployed? Or do you sell the toy in Mexico? It's legal, but is it ethical? That's an ethical dilemma. All right. It's funny, the business law students I teach all raise their hand. Of course, you sell the toy in Mexico. Whenever I teach this to like more the touchy-feely kind of subjects, majors, they're all appalled. But that's an ethical question. We're following the law may not be the ethical thing to do. English Morning, very famous case. As you may know, if you have a small child and they have a high fever and you give that child aspirin, they can develop a very serious illness called RYES, R-Y-E-S, syndrome, very serious. So this Hispanic couple come in with their child to a pharmacy, and they're going to buy a St. Joseph's aspirin for children. They don't read English. The warning is in English. They buy the product. Kid gets it, gets very ill from the RYES syndrome. They sue. So St. Joseph's aspirin for children, people say, well, this is America. You're going to get medicine for your child. You should know English. If we had to put the warnings in every language spoken in this country, the aspirin would have to be sold in a refrigerator box. It's not up to us. You have to figure out what it is. That's an argument. It may even sound logical until you get to the facts where the company heavily advertised in the Hispanic market. Hispanic radio, Hispanic newspapers, Hispanic billboards. Now maybe they should have given the warning in Spanish as well. And that's what the judge said. You had a legal obligation to do it, and then you had a moral obligation to do that, and now you have a legal obligation to do it on that. What about, so there are gray areas, and this is interesting when it comes to advertising and to marketing. It's not black and white, okay? It's ethics. For example, advertising. Let's say you're selling a bag of chips for giant-sized chips for so much money, but now you're going to sell the extra large giant-sized chips for 50 cents more. You have one more chip in it. Is that ethical? Probably not, right? What about 2 chips, 3 chips? How many more chips would you have to put in the giant extra large size so it's no longer unethical? There is no law on that. You have to look at ethical principles. How many more chips you need? The original law dealing with deceptive advertising was done in the 30s and the Federal Trade Commission had these regulations. And the first defendant really was interesting. There used to be a toothpaste company called Ipana Toothpaste. And they advertised for that perfect smile, use Ipana toothpaste. So some guy brought a claim in the Federal Trade Commission. So you know what? I've used this toothpaste for a year and I still have crooked teeth. I don't have it's not perfect. That's false advertising. And the Federal Trade Commission said, yeah, that's deceptive. And went to court. And the court said, well, when they talk about deceptive advertising, it doesn't mean the stupidest person on the planet. It means a reasonable person would be deceived. Same in the nonprofit. What do? You let's say you serve 400 meals a month for homeless people. Can you say, gee, we serve over 400? That's deceptive? Can you say 450 when you only do 400? You say, oh, we probably serve close to 500 people a month. Okay, there's no law. There's no rule. Now, if you have all your financials and everything posted, but if you're discussing with people, what's deceptive? We serve 10,000 people, that's clearly deceptive. Sometimes we serve over 400, probably not. 500, who knows? So how much can you exaggerate your accomplishments before you really fall into deceptive advertising? That is the ethical dilemma. Okay, so is ethics in business, whether for profit or not-profit? Remember, nonprofits is a big business. Is it playing the game of ethics? It'll be very interesting. We'll talk about that. Is business amoral? Is business, first of all, is business like nonprofits, is it amoral? Can you ascribe morality one way or another to a business? Well, Adam Smith, the founder of capitalism, says no, business is a separate entity. It's not, you don't ascribe a morality to business at all. And he said, everybody acting in their own best interest will create the greatest good for the greatest number. And the person who believes, modern philosopher, that was 1776. The modern person is, as Milton Friedman says, the only goal of any business, whether it's profit or nonprofit, is to make as much money as possible and either give it to the shareholders or for their nonprofit purpose. As much, even you can go right up to the line when it comes to law. You deceptive works, anything you can do, just make as much money as you can. More modern views saying that our goal isn't just for the shareholders or just the people that we work for. It's also our employees and our vendors, and are we considering the community and our environment? We really have a much broader view of things. Albert Carr came up with the rule about is business bluffing ethical, which is interesting. Yeah, to him, even deception in business is fine because it's a game. He says business is just a game. If you go to business school, master's programs, you learn, business game words like offensive strategy, winning strategy, defensive positions, and it's just a game. And for many people in business, part of it is like negotiations. Did you ever hear anybody ever tell you this is my best price? That's a lie. You never get the best price, ever, ever, ever. Or you go to a used car dealer and I only got $25,000 for this car. Well, you got more, but that's the game. Okay. And I do the game when I'm trying to settle a lawsuit. I'll say, oh, my client has no money. Okay. And we start from nothing to move up. I lie. All that kind of stuff is fine because everybody knows. I mean, the car dealer knows you're lying. The car dealer's lying. The car dealer knows he's lying. Everybody knows everybody's lying. It's just part of the game. But when people don't know they're part of the game, like people who use your services, thinking that that's what they're getting, or donate money to you, thinking the money's going for certain purposes, that's not the game anymore. All right, so overstating accomplishments is a big one. I told you. Understating your overhead. What about accepting gifts from ethically questionable people? It was a big issue for a while about Michael Milken. You take money from him. A big issue now for nonprofits that I've had to deal with is cannabis. Ventura County now has cannabis companies. Part of their obligation is to give money to charities. If you have a charity that represents children, for example, should you take money from the cannabis industry? And you have to weigh. And there's ways to do that, but that is an ethical dilemma. It's not illegal to take money from the cannabis companies or alcohol companies or tobacco companies. Okay, those are the issues. Also making sure you comply with the gaming rules, raffles, poker nights. Not all nonprofits comply. They figure they're not going to get caught and they just do it. but those raise some ethical and legal issues. So theories, there's different theories. One is the theory of relativism that basically says, okay, for ethics, what's right for me and my organization is right for me. What's right for you is right for you. I'm not going to criticize you. You don't criticize me. And people, that's one way of looking at ethical things. And if you ever hear any organization or somebody say, well, we all do it that way, that is ethical relativism. We all do it that way. For example, in the for-profit business, you know, you ever get these bounce houses, right, for your grandkids or kids? They pay the people cash. Well, they're not, they're employees. And if you talk to them about it, the owners will say, I can't afford to do it. They all do it this way. Nonprofits, one of the things that I see a lot too is you have staff. You say, well, you know, can you volunteer for the event at night? Be a volunteer. We'll get you a meal, you can volunteer. Well, when I confront them and tell them they're not volunteers, you have to pay them for going to the dinner at night. They go, well, but this is how everybody does it. Okay, that's relativism. It's okay for me, you do your thing, I do my thing. Then there's also Immanuel Kant, who came up with these black and white rules, deontology, that says there are certain rules that are absolute. Once you come to them, you can never change. And he called it the categorical imperative. How do you know what these rules are? Well, one of the things you do is you say you have to be able to will your conduct to become a universal law. So if you're deciding whether to break a promise, then you have to agree that everybody breaks promises all the time. Since that doesn't make any sense, you conclude that keeping a promise is a rule, which means you never, 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 never violate it, or lie or cheat or anything else. It's just absolute. And a reporter once asked Immanuel Kant, well, what would you do if somebody knocked on your front door and they looked kind of weird and they said, is anybody upstairs? And your baby sister is upstairs. What would you say? So he said, I would choose not to answer. Because of course he couldn't say no, because that's a lie, it violates the rule, and wouldn't say yes, because it'll go hurt the baby. They do not believe in consequences. Consequences don't matter. It's following the rule. Now, that's like my friend. He has that black and white. Some people do. Sometimes there are rules that we don't violate. The other is, of course, utilitarian. Ends justify the means. John Stuart Mill. He, for making ethical decisions, believes in the consequences. If there's good consequences, then that's the ethical decision. And he does cost-benefit analysis. That's what Ford Pinto did, cost-benefit analysis. Gee, it's going to cost us $137 million to fix. Benefits cost us less. We'll have more jobs. We'll sell these cars. We won't have to redo them. More benefits, cost-benefit analysis. And many times that's what we do. You know, you got to decide to go 75 miles an hour on the freeway. You're weighing this analysis. It's not right, violates the law, but you're not going to get caught. So, and there's some fascinating studies about that. And here's a nonprofit. There was a hospital called Willowbrook in New York from 1956 to 1970. It housed developmentally disabled children, seriously mentally ill children. And it's a nonprofit. Well, the medical people came to them and said, you know what, we're trying to study hepatitis. We'd like to find a cure for hepatitis. But we're having a hard time. So they decided they'll just start giving all these kids hepatitis without consent, without talking to parents. The reality is, by doing that, they accelerated finding the cure for hepatitis by decades. But that's utilitarian thinking. Right. The ends justify the means. The results were good. Some people suffer. That's why, believe it or not, until this year, LA had thousands of sweatshops. You go buy a shirt from Ross or 21, Forever 21 or one of those stores, you know, people are making $3 an hour. That's it, $3 an hour. And why? Because we all like to get cheap clothes and nobody tells us about it. So nobody feels bad. But now, and because the stores like the Macy's, the Nordstroms, the major stores, they would hire a sub, who would hire an independent contractor, be 5 layers down, and they never got caught. Now the law is they can go after starting this year, the main retailer stores.
So Roy,
okay, so that's the utilitarian. Can lying ever be ethical?
Roy, this is Dina. I just we've got about 15 minutes. we have about 15 minutes left, but I know you've got a fair amount
Give
of
me
your
a second.
content left. And
I'm gonna have to do something. Let me get off the camera for just a quick second.
Roy. Okay, folks, hold tight really quick. I know there's a number of questions that have been lobbed in, so I'm going to make sure that Roy has enough time for us to get through all the questions.
Okay, can you?
We can hear you, and
Okay.
there we go.
I-
And actually, your camera's off.
I'm
There
gonna
we
do
go.
something. Okay, I think I can hear you now. Go ahead.
Yeah, so Roy, I've got a whole
I
bunch
hear
of
you.
questions that are stacking up. So, and I don't want you to cut short the rest of your
ahead.
presentation.
Oh, what was this?
I said, you've got a whole bunch of questions stacking up. So, and I'm mindful about how much more of your
Oh
presentation
yeah, I
you
got a
have.
lot here.
Yeah, I know you do. And please don't rush this, because this is actually the stuff that folks are most interested in. I just want to make sure we leave some time for questions.
Okay, so let me kind of more quickly go through this a little bit here, because we've got important things to talk about. All right, so there are different different theories. So one is lying ever ethical? Sometimes it is the ethical choice. Sometimes lying is. Somebody buys a brand new pair of shoes. You may think they're the ugliest thing you ever saw in your life. You might say, oh yeah, they look very nice. You lied. That's the right thing to do, right? We lie to keep peace in the family. Where's your sister? She's in the library. She's not making out in the driveway. Is ethics cultural? Yes. And that is a nonprofit world. For example, bribery. We view bribery as unethical here. In some countries, that's how you do things. You bribe. You follow their rules. It's different. International nonprofits, you go to countries where they don't, women don't talk to them asking for money. So do you send your development director there or not? Those are ethical, but it is cultural, which makes it difficult. And it can be situational, we could talk about. So one of the things you want to do, and the 990 asks, do you have a code of ethics? And you should all have a code of ethics. And it's a great fundraising tool, and it's a great thing to put on your website. So you want to form a committee, and you want to seek input from your stakeholders, your vendors, the people you help, your clients, employees, members of the community, the board. You want to get advice from them. You want to consider things beyond just non-discrimination, kickbacks, gifts, harassments. You're going to want to have a good written ethics policy with some feel-good values in there and the real core statements from your mission. One of the reasons, if you're going to put together a code of ethics, those who are doing it should ask why they're on the board. Do they really believe in the mission, or are they there just for personal gain? Some people join boards just figure they can make business that way. Now, a lot of people join boards because they believe in the mission, and they also think they might, meet some contacts and help their careers, which is fine. But if your goal is only personal gain, they're not the people you want on that committee. So you want to draft it. You want to write it in a very positive and inspirational manner, statement of values. You want to make it so all the board members get to use it. It's nice to set these up sometimes in a question and answer format. Will my money be used for this or that? And you could say no. And it's not a way to do it. You want to talk in your ethics thing about also how you treat your employees, your vendors. We pay our vendors on time. If you say I pay in 45 days, you pay in 45 days, even though it may make better cash for you to pay them in 60 days. You're going to live up to your honors with that. You fair treat everybody. Donors, you're going to keep accurate books and records, transparent. You want to talk about the quality of your goods and services, honest communications, no kickbacks, obviously, not going to have vendors pay you money, so use their services. And then eventually you go through all this analysis, and then you prepare a code of ethics, just like all the major corporations do. And it should avoid the conflicts of interest, talk about how you deal with the public, speaking positively of the organization. And this is good. If you have a board meeting and you vote against something, but it passes, after that, you are on board. You're not going to go around telling the public, well, I didn't vote for that. So you're going to do that. Avoid conflict opportunity, the gifts, confidentiality, the whistleblowing, all these sort of protections you can all kind of put together or as adjuncts to the code of ethics. Professional solicitation versus volunteers. There are people who make a living being professional fundraisers, which is fine, but you need the volunteers. They lend the credibility to the organization to say, I'm a volunteer for this company. I'm contributing my money as opposed to the paid professional. If they are paid, you want to make sure that they're properly registered with the state of California. It is wrong for the board to believe that I need professionals to solicit because volunteers won't. It's not true. If they're trained and they believe in the mission, they will volunteer to go collect money. A professional fundraiser, there can be some short-term gains, but in the long term, it could hurt the company because you hire a paid professional, they'll come in and then they're gone. And so who knows exactly what they might say, the promises they might make. But volunteers, they're there and they provide a lot of credibility. Also, it's wrong to believe that planned giving is too complicated. The volunteers, the board can understand enough about planned giving to at least address the issue with the customers or the other donors. So volunteers, good. You want to get volunteers. Sometimes you hire professionals, but you want to have volunteers. If you're going to hire a fundraiser, again, you got to talk about the proper use of donor funds. Interestingly, try not to name structures after living human beings. We do, but look what happened in Pennsylvania with Coach Paterno. They had to take down his statue. The first president of Stanford University, what was his name? David Starr Jordan. They had buildings named after him. He was the first president of Stanford. Well, he was a major eugenicist, white supremacist. So a few years ago, they took his name off the buildings. Bolt, you hear Bolt Hall Law School? Well, Bolt was one of the originators of the Chinese Exclusion Act in 1882. They're thinking of taking his name off. So be careful about putting living people's names on buildings. We do it, it's what's done, but be careful. Oversee the fundraiser, complete accuracy in fundraising. It's not always easy. Our goal is to raise $1 million. Oh, we're almost there. Well, if you aren't, you shouldn't be saying that. And never use commission-based fundraisers. That's just a no-no. Because commission-based fundraisers, they may stretch the truth. They just want to make the money. They may make promises that they can't keep. You just pay them a salary, you pay them a fee, but don't pay them based on how much they raise. It's not appropriate. Okay, so how are you going to, in fundraising, business judgment rule, and your defense. We had a case where this organization said, we're going to do a house raffle. So they looked at it, they analysis, they hired a person who does these things, made a report. We're going to do it. Cost them $40,000 to put this house raffle on. Nobody bought a ticket. It was a total disaster. And so the board came to me and said, we're going to all be sued. I said, no, you have the business judgment rule. You can make bad decisions. You looked at it, other companies did it, you had a professional come and talk to you, it just didn't work. You're okay. Don't be careful if you're going to solicit money online. For example, if you solicit money online from North Carolina, you've got to register in North Carolina, and their attorney general will want to know about you. You can have a passive website. You can have someone that says, please donate here. But if you're reaching out to people, making direct solicitations online, it opens up issues, and we could talk about that. Gift acceptance policies, you want to have that. The 990 asks about it. The most important part of that is it tells you when to say no. Nothing is worse than having somebody tell a board member, oh, I got this great thing I'm going to donate. You go back to the board and they say, we don't want it. You got to go back and say, we don't want it. Watch out about, I got a boat in Maine, I'm going to donate to you, but you got to get it here to California. No, I got a toxic waste dump, I'm going to donate it to you. You want to be very careful about that. You want to have a clear policy so you don't have angry donors. And the 990 asks if you have these things. So that's a very important thing to do. Also a statement of commitment. You can read this. It's nice to have a statement of commitment for the board members, talking about their responsibilities and so on. I have 10, 11 different points. It's good to have. 990, go through 990. There's 59% of charities say they spend no money on fundraising. That's not true. Generally, it's like $1 for every 3. There's rules like that. You should actually go through with your CPA and your executive directors, parts 5 and 6 of the 990. 5 deals with finances, payroll taxes, income, expenses, and that's where the IRS catches you if you should be filing a 990T, which is the unrelated business income tax. They catch that on those forms. And they talk about all the donor forms. Did you send all the right forms in? If people donate money, donate real estate, and so on. 5 is important. 6 is all about management. Did you amend your bylaws? Anything change? You're missing change. They talk about your minutes, contemporary minutes. Also, the 6 asks if there's been any diversion of assets, any thefts or embezzlement or excess payments, excessive benefits. So 5 and 6 talk about contemporaneous minutes. So they're very, very important for you to go through and know, and don't just check off stuff because it's been that way in the past. Because if you not answering these questions properly does raise the audits. So read them. They're good for you to make your board decisions, run your companies. 990 is going to be very, very helpful. Okay. Yeah, 5 minutes. Okay, thank you.
Okay, Roy, I'm going to go ahead and feed you some questions that came up in the chat box. I'm going to encourage folks to come off mic also. So let's see here. As a new nonprofit director, I understand we have laws to follow and paperwork to file, but who is checking that we're in compliance with these ethical decisions?
No one. So, one thing is accurately reflecting what you do on your 990, understanding those, having all these policies, and having discussed with somebody who's knowledgeable if you have ethical issues. There is nobody looking. The Attorney General only gets involved when somebody complains or there are some forms that are missing. So you're going to have to depend on your lawyer and your accountant to help you go through these things.
And then in your remarks, Roy, you had mentioned good insurance policies versus non-good insurance policies. How would nonprofit staff and board members make that determination?
Contact an insurance company, and if somebody contacts me, I give the name of brokers who do nonprofit insurance, who's maybe even specialize in D&O insurance, and have them come in and explain what's being covered, why it should be covered, and the cost. You have to do a little due diligence, but there are many companies that really handle nonprofits and their D&O insurance. Just do a little due diligence.
So I also have a scenario here with a nonprofit organization that wants to add a benefit or service to its membership, like guided tours. Through that lens of ethical decision making, what should the board consider about adding benefits to their membership strategy?
The question really becomes, is this a public benefit? Is the money being spent for the public benefit? If the tours are, somebody pays $200 and they get a $200 tour, that may be okay. It should be in their bylaws. It should be reported on 990. It's going to be unrelated business income. It'll be taxable. It can be done, but you can't be giving it away because that's not really a public purpose because it's members. And is this a 501c3, you think?
Yes.
Okay, so yeah, it's unusual to have members, actual true members in a 501c3. We don't recommend it. They could be members, like being a member of the LA Zoo, but you don't vote and you don't pick directors. So it depends what kind of members they are. But if it's a benefit, I think that's fine. It should, it's interesting. If it ties into the scope of what your nonprofit is, that's one thing. If it's totally unrelated, I'm feeding the homeless, but I'm doing tours to the Vatican, I'm not sure that's appropriate. But it may be done as a goodwill, and maybe if you can make money doing it, it might work. But it is a complicated question.
Well, and that's a question I don't know the answer without engaging the person who posted it. But I think you're differentiating membership as a revenue strategy, right? Like I'm a member of the zoo, right, versus being incorporated as a membership nonprofit organization, which gives me a different level of governance authority.
Right.
And I don't know the answer for this particular organization. I suspect it's a revenue. It's a fundraising strategy and not necessarily a corporate structure.
So as long as they're not using public money to give people these tours, it's probably not a problem. If they're if they cover their own costs, it's just sort of gets their name out in the community, the marketing tool, maybe it could work, but they shouldn't be using their donated money to let people go on cheaper tours, unless that is their charitable function.
So Roy, this last question that I have for you is a whole nother webinar unto itself, but just maybe a little bit of information, insight from your perspective about the difference between independent contractors and employees.
Very hard to be an independent contractor today in California. Okay, from the lawsuits and the cases and the recent legislation, it's very difficult. There's some statutory exceptions. You have to look at it, but basically, unless you meet one of these categories that have exceptions, if you tell somebody where to go, where to be, you could tell them, do it again, I don't like what you did. You pay them by the hour, they're going to chances are be employees. You're going to give them a business card, chances are they're employees. Independent contractors are people in their own business. They have a business license, they market themselves, they work for others, they got a website, got their own cards, and they set up their own schedule. And you pay them generally on a project basis.
Terrific. Well, Roy, we've come to our end of time. I've dropped the evaluation form in for those. And just say thank you very, very much for your time this morning. A post-event email is going to be coming out with a recording of today's session, which I'm going to stop right now.